All right, I got JP Peak Exchange talking 1031 exchanges, all about them. Thanks for joining me today, Jay.
Oh, Matt, my pleasure, man. Glad to be here.
This is my favorite part of it, just having open conversations as a mortgage broker and more importantly, probably a real estate investor. I've got the same questions that a bunch of clients have. And so I like to go live, get them answered from an expert like yourself, and hopefully this video finds somebody who's like, oh, you know what? That sounds like me. I'm selling grandma's single family house that we've kept in the house in the family, and I've rented it for $5,000 a month over the last 6 years, but I could probably exchange that into a asset that pays us more, whatever the case may be, right? Like there's a lot
Sure.
of different uses of this. So I think the best place to start is just for people that don't know, like, what is a 1031 exchange?
That's a great question, and it is a good place to start. 1031 exchange is probably one of the best left tax advantages property owners, investors can use to continue to build their portfolio, to grow their wealth exponentially without having to pay Uncle Sam for the right to do that. It is a deferral method, so it's not the avoidance of tax, right? That kind of is a big misnomer. We don't want to use the words avoidance, right? It defers the gain. So basically, if you've got an investment that you've held on to and your intention is to sell that investment, to take those dollars into a new investment, maybe a different type of investment, but it all being real property, you can do so by enlisting the services of a qualified intermediary. And by doing that, all of the tax is not paid, but deferred into the new investment. And you can keep doing that investment after investment after investment. And that there's no adage in the industry that you exchange, 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 and then die because your heirs get a step up in basis and they don't pay any capital gains tax at that point. So it's really reserved specifically and exclusively for real property investors. And so the first question I usually get is, okay, well, if I'm selling, there's four fundamental or statutory rules. So I'll bring those up so that we've got those kind of under our knowledge base. And the first is if you're selling a property that you've held for investment purposes, you've got to buy a property that you also intend on holding for investment purposes. And the IRS uses the term like kind. And that's usually where the first hiccup happens. Like, okay, well, what does that mean? Does that mean if I'm selling a 3-bedroom, 2-bath house, I have to buy a 3-bedroom, 2-bath house? And the answer to that question is no, you don't have to. You can, but you can also buy vacant land, commercial property, fractional interest in something else. As long as the intent is to hold it for investment purposes, almost anything will qualify. So it makes it easier kind of to talk about what doesn't qualify. And that is, if you're using it personally, if it's your primary residence, with a couple of exceptions, which I'd love to chat about, that usually won't qualify, or one that you're vacationing in, a second home, those types of things. There's some stipulations that will qualify, but if you're using it personally, there's going to be some hurdles or some hoops you have to jump through to qualify for that property to be eligible for a 1031 exchange.
Right, for sure. Real quick, I got a couple follow-up questions, but I
Yeah.
rudely forgot to introduce you and, and
Oh,
and who you
sure.
are and why we're listening to you. But yeah, who is Jay Pete from Peak Exchange, and why should people listen to you and trust your advice on this 1031 stuff?
I just jumped right in there, didn't
It
I?
was my fault. Yeah.
Yeah, no, it's all right. I think you know what evidence will be proven by knowledge base, right? So that, but I started my career in real estate over 20 years ago. I got involved in title and escrow. Spent some time working in a title plant, figuring out and how to mitigate title issues that can come up, saving my clients headaches and money. I went into the 1031 exchange arena and got certified as a specialist in 2006. There were fewer than 100 certified specialists in the country at that time. I've trained attorneys, hundreds and thousands of attorneys and CPAs all up and down the state of California, thousands and thousands of realtors all across the state and the country for that matter. And I've been involved directly in real estate investing. I've coached and trained, again, a lot of people in the industry on how to use the tool of the 1031 exchange to parlay their wealth going forward. I'm a proud member of Peak 1031 Exchange. They are one of the largest independent exchange companies in the country, and named one of the best in the 1031 exchange arena. Great company.
Awesome, man. Yeah, there's a lot to talk about with 1031 exchange. It's cool for me as a mortgage broker I get to sit in this seat and I get to live vicariously through investors. So I get to be a part of a lot of these cool investments, but I also get to learn and see what they're doing. How are they filing taxes? How are they,
Sure.
in the case of the 1031 exchange, deferring taxes? And so, for the audience to just like understand it at a baseline level, I love using numbers and examples. You bought a place for 300,000 that you've held for 2 decades, and now it's worth $800,000. If
Hmm.
for whatever reason that single family home in Livermore, California, it probably rents for $3,500, and like let's say it's paid off, so you got $800,000 in equity. Like your
Yeah.
return on equity, which is a term that investors use, there's better uses for it. And so, just so people understand, you sell it for 800,000, you paid 300, your CPA is probably depreciated that over the years. You're going to have a humongous tax bill if you just sell it and don't roll that, via this 1031 exchange into something different. And so I just want people to hear that and understand that. If you're confused, you don't understand, most all of us would agree writing a check to the IRS for 200,000 isn't the play, right? It's
Oh,
going to
yeah.
be, what, in this other market in California, I can go buy a fourplex for $800,000, and this thing might rent for $8,000 total. Now, instead of getting $3,500 in rent and getting 8,000, sounds like a great deal. What are probably the mistakes or misconceptions people have about 1031 exchanges?
I would say I host a podcast, and a lot of times, or I did a radio show for years, and there would be calls, a time where we took calls, and the switchboard would light up. I'd take the first call, and the guy would say, "Listen, I just closed escrow on a sale property. I found out about this exchange. I'm glad I dialed in today. Like, what's my next step?" And I respond by asking him the pointed question: "When did you close escrow?" "We closed escrow a few days ago." "Excellent.
Money
You got
just
your
landed in my bank.
yeah,
Yippee!
yeah, that's great. Okay, take your checkbook out and write a check for about anywhere between 30 to 45% of what you received in gain, because your exchange opportunity is over. You failed. And the first thing you need to know is you have to have a qualified intermediary involved with the transaction. And 1031 exchange company, QI, accommodator, all those words are synonymous. And what you need to do is to make sure that that entity, that person, is signed into the transaction before you close escrow on your relinquished property. Because if you close escrow before that happens, it's too late. So the QI gets assigned in to receive the benefits of the sale. And so what are the benefits? Well, the cash, not the liability of the tenants, trash, taxes, toilets, none of that stuff. So escrow closes, the money comes to the qualified intermediary, and then you're out there looking for a replacement property, and you have 180 days to complete that task. But job one is to make sure you talk to a reputable QI who knows the rules and regs, who can give you some guidance in what the IRS requires. I'm not standing, and I've taught thousands of CPAs and attorneys, but I'm not standing on a soapbox saying, "Hey, listen, I can give you tax and legal advice." That's not what I do. What I do is can tell you what the rules and regs are, so that you can then take that to your CPA and make the right decision for you, because not everybody's taxable situation is the same. Like, I don't know, Matt, if you've got loss carry forwards and you don't need to exchange because you're going to be able to absorb this gain somewhere else. So you're always going to want to talk to your CPA, but having a reputable QI is job one. If you don't have that, or if you have somebody that's just saying, "Hey, yeah, we can put the paperwork together, but I can't give you any guidance, any rules and regs," that's going to be a problem. You're going to want to talk to somebody that can give you that information so that you can go back to your CPA and attorney and save yourself some hours of discovery, which is they're all billable. So having a
Yeah.
qualified QI is job one.
Right. As you're talking, I'm thinking to myself about the parallels between your services and maybe a mortgage broker, where I always tell people, like, have a plan. It blows my mind where people will exchange, the biggest financial transaction of most anyone's life is usually real
Mm,
estate. And they'll do it, whether it's purchase a house and they took 17 minutes to do the pre-approval on a Sunday night, then had an offer
sure.
go out. And I'm sure in your world too, it's like you're dealing with six-figure tax bills, you're dealing with hundreds of thousands and sometimes millions of dollars in real estate. Like, talk to somebody, have a plan, because it's worth it, right? And
Yeah.
so you mentioned briefly, the identifying period, but if somebody, like you said, they have to reach out to you guys and they have to have that set up so that funds don't land in their bank account. It's got to go to the uh, exchange company, the intermediary. Can they call you guys 3 months before they sell to talk
Oh,
and put together a game plan?
absolutely. In fact, I encourage it. Having that plan in place is going to be, it's going to save them a lot of grief, and it'll make everybody feel more comfortable knowing that they have a plan. Escrow, the real estate agent, the on the sales side, the real estate agent on the buy side, their CPA. I mean, everybody's going to feel more comfortable. I sit in a couple of family offices, and we get together once a quarter, and I'm in the room with the CPA, the financial planner, the realtor, the family, their CPA, and we discuss strategy that is going to be that's best going to suit the family. And I kind of encourage. It's kind of something that most people don't know about. They don't because usually if you got a net worth of $100 million, you've got a family office. But there's a lot of people that could still benefit from having that group of individuals in their lives. You don't have to have $100 million net worth to have that type of collaborative group together. And the accommodator talking to the CPA. I've done a number of deals where the CPA was just blown away at what we could do because and I give it to a CPA, right? I'm the master of one tax code. That's it. I'm not going to say I'm an expert in anything else, but the one code is a book this thick. A CPA has to know them all. How is that even possible? Right. So I love being a resource for the CPA as well. And we can get really creative with some of the stuff that can be done with regards to reverse exchanges, built to suit exchanges, seller carries, and how those incorporate into an exchange. Because most accommodators will tell you, you just can't, once you convert a grant deed interest into a trust deed interest, the exchange opportunity is gone. Not necessarily true. There's some options there.
Right. Yeah. I think the moral of the story there is just like I advise on the mortgage side is, talk to somebody. Don't be
Yeah.
afraid to plan and pick up the phone and have that conversation because like you said too, everyone's situation is different. And the $100 million family office has different you know goals and strategy than
Yeah.
the mom and pop investor. And that's the cool part. If you're listening and you're like, oh well, I'm just a small fish, I've got one property that I'm going to exchange into one other investment, it works for you just the same. You get the
Absolutely.
same tax advantages. And so there's plenty of mom and pop investors, and I think I'm a champion for those. I am one myself. um, Using this stuff, you should be using all the same stuff that the $100 million family office is using from a tax strategy perspective. It's like, you know, you don't want to pay a bunch of money to the IRS unnecessarily when there is this tax code that allows you to go out. And in my opinion, it's optimizing your real estate holdings is really how I look at it. That's what the people in my world I think are using it for. Is you, you told me not to use the word avoid, so we're
Deferring.
deferring taxes, right?
Yeah.
But really, like if you had to pay the tax, it might not be worth it to sell one property and buy another. But if you're going to seriously optimize, cash flow, or, everyone's situation is different. Maybe it's not a cash flow thing. Maybe it's just that you're 77 years old and you don't want to do anything that feels active in real estate. So you want to buy a
Sure.
commercial property that's triple net lease, and it runs itself, and maybe it is the same exact cash flow as the fourplex you own in downtown Sacramento, but now instead of
Zero headaches.
right, the headaches of it and the tenant laws, you're like, I'm going to buy this property that Starbucks is leasing, right? Like, okay,
Yeah.
they've got a 10-year lease. I know their money's good, and it's a triple net, so they're paying tax and insurance, and like you're really, really hands off. So there's a bazillion different uses of it. I love hearing stories, man. I think people resonate well with stories, whether it's an off the wall wild one. I mean, shoot, man, if you had a radio show, you've probably got endless stories.
Yeah.
Tell
There's
us
a few.
maybe let's start with a disaster. People love disasters. Maybe
Okay.
something got off the rails and you guys had to come help them rescue it, or
Well, I'll point back to one of the things that I mentioned earlier. It's like you have to have that qualified intermediary, and there's not much to be there's not much required by the state to become a qualified intermediary. You've got to have a bond and $50,000, and you can hang a shingle as a QI. And so one of the horror story that I can tell is that somebody that I was, I'm in the Santa Barbara, San Luis. I cover every for peak. I'm all over the country, but this was a Santa Barbara company, and it was a 1031 exchange company, and they sold all their deposits to another company. Didn't inform their clients because they weren't required to. That person lost all of the money. So they misappropriated the funds. All the exchange funds were gone within a matter of weeks. And so, could you imagine you close escrow on your sale property, the money's with the accommodator, you're out there looking for the replacement property, and escrow's calling the accommodator looking for your funds, and no one's answering the phone. They're out of business. And so your money's gone. Not only is your money gone, you didn't complete your exchange. Taxes are due on because your exchange failed. Taxes are
oh,
due on the sale of your relinquished property. So having the right QI is imperative. And I went to talk to a gentleman that was burned by that company that failed, and it was his life savings. It was horrible. There was nothing that I could do. Once you choose the wrong company, you're assigned in. They are assigned into the transaction. You're screwed. So due diligence on the company that you're using is imperative. Imperative.
yeah.
Ask the questions like, "What are you doing with my funds? What are you doing with them?" Peak, we put them in a qualified escrow account with the bank. They just sit there. It's safe. So when you want it, you ask for it and it's there. Money can't come in or go out without our client's signature. But there isn't any regulation in that arena. So it's really important to know who you're working with. That's kind of a scare that everybody should be acutely aware of. Make sure you're working with a company that just puts your money in the bank and keeps it safe.
Right. Yeah. Holy moly, man. What a nightmare. Because yeah, most of the time, people have a lot of their net worth tied up in
Yeah.
real estate. And so if you're exchanging it, it's like, yeah, this $400,000 in proceeds is going to go towards my next one. Man, what a nightmare. Just a quick plug for Peak too. How long has Peak been around so people can trust that when their money gets deposited with
Yeah.
Peak, it's going to be
Um,
there on the way out.
They've been well over a decade. They were part of a larger group, and still our Peak is a big organization. They do hotel retrofitting. They're a construction company. They've got a bunch of different arms, but the exchange company itself has been around for I think 12 years total. I went to work with them because Steve Rosansky, my mentor in the industry, gave me a call and said, "Jay, you got to see what we're doing down here." They are the most efficient company I've ever witnessed. A reverse exchange, I've worked with a couple other exchange companies. And a reverse exchange can take 6 to 8 weeks for the company to create the exchange documents, the LLC, all the things that are required to make it happen. These guys can get it done in a matter of hours because they're so nimble, and they've got attorneys on staff pulling documents. They are just a powerhouse of comprehension. It's really cool to be with somebody that's that nimble and yet that secure. They've got a bunch of money on deposit, and they haven't had a failure. So it's a great company that I'm honored to be with.
Awesome, man. You mentioned reverse exchange. Explain to everybody and refresh my memory too, because I feel like it's one of those things where as a mortgage broker, I've got guidelines galore. I've got so much. Sometimes I
Sure.
gotta clear the database, and so I probably don't remember exactly how. I mean, yeah. But besides the fact that it's like reverse tells me I'm going to buy the property before I sell the last one, but what all goes into a reverse exchange?
So a reverse exchange is just that. Like you found the replacement property you want, but you haven't sold anything yet. And you cannot, the IRS says you cannot exchange onto property that you already own. So what happens? You need to close escrow, and where it usually shows up is, let's say I'm in escrow with both properties. I'm going to sell my relinquished property on June 15th, and then I'm closing escrow on my replacement property on June 20th. Right? That's a or just those are great days, right? So what happens is my buyer for my relinquished property says, hey, loan conditions haven't been met. I need 2 weeks. The replacement property, I'm not giving you 2 weeks. Close escrow. We got a backup offer, or you're out. Like, oh crap, I need to close escrow on this guy first. That happens a lot more than you would think. So what happens is that the qualified intermediary steps in. They create a single purpose, single entity LLC. That's what we do. Not all exchange companies create a single purpose entity. They'll have one LLC that owns all the real estate, which is there's the whole like fishnet of things that can go wrong there. So we do a single purpose, single entity LLC. That LLC then buys the real estate on behalf of the taxpayer, the exchanger. The exchanger then gets an absolute triple net lease. So they still receive the benefits of the ownership, but they're not on title. Once that happens, once escrow closes on the relinquished property, the same timeframes are involved. We haven't talked about some of the statutory requirements, but one of them is you have 45 days to identify the property that you're going to sell or buy, depending on what type of exchange, and 180 days to complete the 1031 exchange. So once you close escrow on that replacement property in a reverse, you've got 180 days to sell something, sell the property you were going to sell. And Matt, this is from a lender standpoint, if you need to borrow money, because who's going to pay for this property that the LLC is owning? Because the exchange company doesn't pony up the cash to buy the property, but the exchange company does own, for the benefit of the taxpayer, the LLC. Who is going to lend to a non-recourse LLC? Like not many lenders. So you really have to have, and that's where like the creativeness comes in. Like you could work with a client, listen, you've got other assets, you can cross collateralize, sign personal guarantees, but the taxpayer can actually become the bank, lend the money to the LLC, and then when their true property sells, that money flows back to pay off the trust deed, so the money goes back to the original borrower, whoever it is, Uncle Vito, the bank, your cross collateralization, whatever it might be. So there are a few more hurdles in a reverse exchange, but know that if you're working with the right company, they're not unsurmountable. It might be an extra hurdle in the race, but we've got the legs and the strength to get it done.
Awesome, man. Yeah, you know what? I hadn't thought about the scenario you posed, but I'm sure it happens all the time where you've got, simultaneous transactions going on for whatever reason. Your replacement property is going to close before your relinquished property. And so you've got to have that mechanism to be able to do it. And like you said, pick the right company to work with, because maybe the company that you chose doesn't do those. Now you're
Yeah.
SOL. It could cause a big problem. And so there's that scenario. And I'm guessing that some people, for one reason or another, just say, I want to buy first.
Yeah.
And so in those cases, maybe tell me, what are the pros and cons? Because in my world, people are like, oh, I want to buy my next residential property before I sell this one. And, I can do a bridge loan. I can do a HELOC. There's pros and cons. There might be a holding cost. It might be this. So in your world, reverse exchange, that somebody just says, yeah, I'd rather do it that way because I want to make sure I get a great deal, and then I, can prepare this property that I'm relinquishing better, whatever the case may be. What might be some pros and cons to think about if they're going to set it up that way?
The pros for most people is the removal of fear. Because when you're doing a delayed exchange, when you close escrow on your relinquished property, you have 45 days to identify the replacement. You have 180 days to close escrow. And the fear is, gosh, what if I don't find something? Well, if you don't find something in 45 days to identify, then your exchange is blown. And now you pay taxes. You're like, well, heck, I wouldn't have sold if I knew I was going to have to pay taxes. So the reverse exchange alleviates all those fears because you know you've got the property. It's already in escrow. You've closed escrow. The clock is ticking. And now you just have to sell something. And you can always sell something. You don't have to have a fire sale, but you can always sell something by reducing the price, making it more attractive, whatever it might be. There's all sorts of things you can do to make your property sell, but you don't have to worry about that fear. So that's why people would do a reverse exchange. On the other side of that coin, you do the reverse exchange, and let's say you're not willing to budge on the price, or the market stalls and nothing's selling. Worst case scenario is you own both properties and you can't exchange onto the one you wanted to exchange onto, but you still own it. That doesn't prevent you from exchanging onto another property. So you still got the exchange opportunity, but you now have both properties. So
Right.
that's the downside to it. I I've never seen, I mean, I've been doing this for over 2 decades, close to $2 billion in 1031 exchanges. And I've seen a couple of reverse exchange failed, but I've never seen somebody devastated by the fact that their reverse failed, if that makes sense, because they wanted the property anyway. And now
Right.
it's just a new property in their portfolio.
Right. Yeah, I think we jumped past it, and but you've mentioned it too, for people's knowledge. Maybe just a quick review of that identification period and close the 45 and 180 rules.
Sure. So the four statutory requirements you've got, like kind, which we went over, the time frames you have. Once escrow closes, you've got a clock that starts ticking. You've got 45 days to identify, 180 days in total to close. The IRS doesn't care if your 45th or 180th day is Christmas Day, Sunday. If you're not getting it done, your exchange is blown. There is one exception, and that is if you are an affected party member to a presidentially declared disaster area, you can get an extension. And so when we have wildfires, everybody that was affected by the wildfires in Southern California, they've all got extensions. Paradise, when that place burnt, they all got extensions if they were involved in an exchange. So there is one exception, that's it. But that otherwise, it's pretty steadfast, 180 and 45. The other two statutory requirements are one is the value. And this is where a lot of people get confused. So in the scenario that you brought up earlier, you bought a property for $300,000, and then it sells for $800,000. You've got a $500,000 in gain there. When you sell the property, you've got hard costs. You've got escrow, title, document transfer tax, real estate commissions. Those are going to come off the top. So in the story, let's say that you have an $800,000 sale that you paid, that you bought it for $300,000. You take that 10% cost, let's call it $80,000 off the top for the sale. So now your net sales price is $720,000. When you do an exchange, you need to purchase replacement property equal to that net sales price, $720,000 in our example here. If you don't, if let's say, well, I've got $420,000 in gain, I just want to use that, you're going to pay tax on the difference between what you sold at your net sales price and what you didn't purchase to. And you can do that. Like let's say the 720 is the net sales price, and you find the perfect property for 700,000. You can still do an exchange on $700,000 into a $700,000 property. You'll just pay tax on the difference. So it's not an all or nothing, which is great, but it's that net sales price that's the magic number. If you touch any of the cash, you're taxed. And if you buy below the net sales price using all the cash, you're going to pay tax on what they call debt relief.
Okay.
So, but you don't have to go into debt. Like that's another misnomer. So let's say in that scenario, I found a property, the loan was paid off at the close, but I don't want a new loan. I mean, my loan on that property was 3%, and I don't want to get a new loan on the new property, but I've got 300 grand sitting in the bank earning me, it's earning 1.5%. And if I put it in real estate, I'm expecting my appreciation over the next, 7% a year for the next 3 years. That's 21%. I want to take that $300,000 out of the bank and use that to offset my debt requirement. And you can absolutely do that. That's the value of the exchange. And then the other is vesting. The last one is vesting. Whoever sells the relinquished property must buy the replacement property. And that sounds pretty simple, right? But sometimes you own the property in an entity. Let's say you own it in a multi-member LLC. Matt, let's say you and I own an LLC together and we have a piece of real estate. I want to go into assisted living and you want to go into commercial. We can't go our separate ways because that multi-member LLC is a tax-paying entity. So that tax-paying entity sells the real estate. That tax-paying entity has to buy the replacement property. And so and again, talking about strategic planning, if knowing we wanted to go different directions, we could have dissolved the LLC, held it as tenants in common with an operating agreement, and then filed a final tax return for the LLC long enough to satisfy the IRS. We're now holding the property as tenants in common. And then when we sell, we can go our separate ways without any headaches.
Okay. Yeah. Another reason to call in advance and plan a little bit.
Yeah.
Um, I'm gonna selfishly ask some questions, to understand kind of the numbers that you went over, because I know it's easier for my brain to understand. I know there's some, term like a boot. And so, real life scenario, I own a 4 unit in Marysville, California.
Okay.
Uh, Bought it for 330,000,
Okay.
and let's say I sold it in June of 2025, probably would sell for 550,000.
Okay.
So $220,000 in gain. I believe I owe something like $240,000 on it.
Okay.
Sounds about right. Um, so if I let's do that 10% off the top, call that 495 after real estate fees, title fees, and all that stuff. Um, if I go and buy something that costs $350,000,
Mm-hmm.
nice little townhouse, um, in a better neighborhood, um, the difference between the 495 net sales price and 350, that 145, I'm gonna be subject to tax on that.
Correct. But you can also use that. So let's say you've got the debt of you bring the debt over to the new property, the townhome in a better area, and you use not all the cash, but some of the cash, and you end up with the difference of, well, what is it, $145,000 left over, whatever that number is. You can put that into something else. You can buy multiple properties. You don't have
Right.
to buy just one. When we're
Right.
talking about that identification rule, you can identify up to 3 properties. The requirement is that you purchase to that net sales price, but you can identify and purchase more than one. So there's 2 rules for the identification process. One is identifying up to 3, the value is irrelevant. Let's say that property was a $10 million property, and you wanted to diversify and buy 10 $1 million properties. Well, the first property rule of identification won't
Oh, I think you just muted somehow. Uh-oh.
more than 3 properties. Sorry about that.
There it is. There now we're back. Okay, so
Sorry.
yeah,
Yeah.
multiple properties.
Yeah, so if you want to buy multiple properties, you can identify 200% of your sales price. So, and in a scenario where you're looking to, let's say you're looking to sell that $10 million property and buy 10 $1 million properties. If you want to buy 10, you've got to identify them, right? That's a rule. You have to identify within 45 days. The IRS gives us the 200% rule, where you can identify 200% of your sales price. So if I have a property I sell for 10 million, I can identify 20 $1 million properties, but my requirement is to just buy 10 of them. And
Right.
so there's 2 rules of identification. There's an exception to the rule that I've never seen anybody accomplish, so it's not even worth mentioning. But there's 2 rules that most people follow. So in your scenario that you gave, if you had a sales price of 550, you had 10% cost, 495 your sales price, and you buy a replacement property for 350, if that cash that's left over, so you'll pay tax in one of 2 ways. One, if you touch the cash, right, that's cash boot. You're going to pay tax on that. If you put all the cash in the property, but instead of replacing that $240,000 note, you get a new loan for 100 grand or whatever that dollar amount is. You have debt relief, and you'll pay boot or tax on the difference. So you'll pay it on what they call debt relief.
And
So
that's
you
all the
you
same rate, whatever your capital gains rate
yeah,
is.
Correct. And so you've got state, fed, you're floating around 25% there. If you've got depreciation, that is a straight line recapture rate of 25%. And that's where things can get really ugly. Like you can get into the 40, 45% tax liability. And there's like the hot topic. Everybody, well, it was Trump's last administration. He did some incredible things with cost segregation, allowing you to take your full cost segregation value on an investment year one. So for cost segregation, if you're aware of cost segregation, if the
Yeah.
audience isn't, I'll talk about what it is. So you've got real property. The 1031 exchange refers to real property, and if you buy a house, it's got windows, carpets, plumbing, electricity. What you do is this hybrid situation where you bring in an engineer and a CPA, and you pull out those things that depreciate faster than the house itself, and you accelerate those depreciation schedules. So instead of writing off the depreciation for, let's say, a residential home of 27 and a half years, you might get a big chunk of it's $100,000 that you can write off in 5 years. So if you've converted real property to personal property, how does that affect the 1031 exchange? Now, it hasn't been tested yet. I haven't seen anybody come through with, well, I did this exchange and we're just converting it back to personal property or real property for the exchange purposes. But there might be ramifications if you're doing a 1031 exchange, you did cost segregation and you don't segregate the new property. Because you can exchange real property for personal property for personal property. I'll use a hotel as a great example. So a hotel has hundreds of thousands, if not millions of dollars, depending on the size of the hotel, in fixtures, furnitures, and equipment. And so when you sell a hotel that has that, you've segregated all those things out. You're doing an exchange on the real property. You're also doing an exchange on the personal property into identical personal property items. We talked about how broad real property is with regards to IRC 1031. Real property investment, real property investment. It could be vacant land, apartments, condos, commercial, residential. When it comes to exchanging personal property, it's very specific. The IRS is using SIC codes. So you can exchange gold bullions for gold coin. You could exchange paintings for paintings, but you can exchange cattle for cattle. But you can't exchange bulls for heifers or bulls for, the gender. You can't cross genders. It's that specific. So when you're exchanging personal property, which you can, and car collectors do that, they'll sell a specific car and they'll buy a different car. You can do an exchange because you've got gain in that sale. But you can't, sell a car and buy a semi truck. They're both vehicles, but they're different SIC codes.
And you can't go from when they were talking like kind, it can't be real estate investment to gold or gold to real
Correct.
estate.
That
Okay.
they're not like kind at all. So
Uh,
it's a specific asset. Yeah.
Okay, man. So much stuff to get into. We could be here all day. I think
Yeah.
I think what I'd love to know to kind of wrap this thing up, because we've talked about, examples and pros and cons and all that good stuff. In closing, I'd love to get your take on the future of 1031 exchanges. I know for a little bit of time there was some talk around 1031 coming to an end. I think a lot of real estate groups that I'm a part of, we're
Sure.
freaking out. It's the greatest thing of all times in a lot of investors' eyes. So for it to go away would be, devastating, I think, for some people. But what do you see for the future of 1031 exchanges? Whether that's legislation or just how they're done.
It's a great question, and I will say that it's every 4 years around an administration switch. There's talk about removing IRC 1031. And this is I don't have a political position here, but politicians who are looking to try to pull some taxable revenue from somewhere. Oftentimes will say, hey, listen, let's get rid of this 1031 exchange thing. So the conversation starts. And that's when people get, oh my gosh, the new administration is going to strike the 1031 exchange because they're trying to change the loophole for the wealthy, right? And we both know that guys like you and me, I mean, I don't have $100 million estate, but I am using the exchange to try and build a legacy for my family. And this can help the little or middle guy take his wealth to the next level. So it's not like closing a loophole for the wealthy; it's closing a loophole for everyone. And what happens is the economists get involved, And they say this, they ask these questions. Okay, if you close that opportunity, so Mr. Condo owner or fourplex owner is going to not be able to do an exchange and pay those taxes. Is he going to sell? Well, probably not. He's probably just going to hold on to it,
Yep.
right? So what happens though when the property does sell? So if he can do an exchange, right? That's right. You're not going to get that capital gains, which is actually at a pretty low rate, 15% federally. So what happens when the property sells? Well, let's talk about the engine, the economic engine that's created when a property sells. First, you've got inspections that are being done. So you're paying an inspector, you're paying for improvements, you're paying for pest work. There is real estate commissions, there's escrow fees, there's document transfer tax, there's an increased property value taxation at the county or the county level. There's again real estate commissions, if I mentioned that. So all of those are taxed at the ordinary income tax rate, much higher than long-term capital gains. So if you want to stall the economy, 44% of our GDP or of our CPI is housing.
Wow.
So if you stall the investment sales, and in my area, 28% of all the homes are not owner occupied. So if you stall that segment of our economy, it is going to have a devastating effect on your CPI.
Yeah.
And so
Agreed.
so the economists bring that conversation up and the politicians go, okay, we'll find something else.
Right. Yeah.
And again,
Yeah. Continue the
I'm not
1031 exchange. Yeah.
Yeah, I'm not picking on politicians. I mean, I commend their goal for wanting to, increase the overall benefit of the country and or if you're in a city, the cities are incorporated. They have, they're basically you've got your board of directors, which is your city council. You've got your city manager, which is the CEO. They're all incorporated. They're corporations. They're all incorporated. So, in any case, that's my take on it. Because I've seen, being in the business for the last 25 years, I've seen multiple administrations say, okay, let's strike this 1031's on the chopping block. Let's talk about it. And everybody kind of gets scared. But the reality is it's such a revenue generator. It's an revenue engine for our economy.
Right. Yeah. Stopping it would do more harm than good, I think.
Absolutely.
Awesome, man. Well,
Absolutely.
yeah, I appreciate your time today. Where can people reach you? I'll definitely in the comments leave all your contact info and all that. But is there a specific way you like people to reach out? Shoot you an email or?
Yeah, they can call, email, text. My phone number is 805-250-3030. Email address is my first name, Jay. P is my last initial at peakexchange.com. And I'm like you, Matt. We really work. We build and work for the futures. Right. My major definite purpose in life is to help as many humans as I can for the positive before I leave this earth. So if somebody needs help, even if I can't help them, I'm going to extend the laurel leaf and give them whatever information I can so that they can make the best choice for themselves. And that's what powers my batteries. It really does. You had mentioned, we talked about a horror story. I do have a great story of a farm family that lived in the valley. They had a dairy farm, and the farm had afforded the kids' college tuitions and funds, and the kids weren't coming home to run the dairy farm. And so they didn't know what to do. I helped them with an exchange into an apartment complex into another part of California, and got them a life estate. They got to live in their house till they died, and they made more money on the rental property than they ever did on the farm, and had no more headaches.
Right. Property manager probably running it. And
it was like, so those types of, that's like a superhero moment. I felt like I literally felt like I had a cape on for a week. It felt so good to be able to help that family. And those are the things that I live for. So if I can help you or any of your clientele or any of your listeners, I am absolutely happy to do that.
Awesome, Jay. I appreciate it, man. Definitely use you as a resource for all things 1031. So thanks again for your time, man. Have a good day.
All right, but you do the same.